And it's great to have you with this call. Why'd you make it?
Well, I mean, it's kind of a continuum of where we upgraded it, from where we upgraded it this spring. Things going pretty well for them off of a pretty depressed level in our sector. It's as concentrated as it is in the broader market. But as the great Judge Smales once said, the world needs ditch diggers too. And 3M has been one of the most dramatic underperformers in our sector over the last 5-6 years. We think that's bottomed with a new management team, a really compelling story around productivity and margins that's just starting to be discounted by the market, and 30% upside from here is still very attractive.
What you're really talking about is a pretty long-term setup as well, it sounds like.
Yeah, I mean, as things take a while to play out on the upside, this thing got to really bargain basement levels on the downside, and the wind back up we think is going to be multi-year in nature. New management came in here this past spring. New CFO came in the last couple of months. They have yet to really lay out their plan for the next 4 to 5 years. So the stock sold off last week on a good result, but not an amazing one. They're going to have an investor day in February. We think the management team is going to lay out an extremely compelling story for the next 3-4 years, where we see an anchor that's comfortably north of $10 a share in earnings, maybe even 11, and the stock at 125 versus a group that's trading well north of 20. Screens very well.
Yeah. Josh Brown is on our program today. He's a shareholder, has a question for you, Steve. Go ahead, Josh.
Hi, Steve. Thank you so much for coming on. I wanted to ask you if you could ascribe a kind of percentage to how much you think this thing has moved on just excitement over new management and fixing the company versus actual fundamental improvement. Because if most of what we've seen so far is just excitement and maybe people willing to give this thing a chance now, I actually think that's a good thing, because there's still many quarters ahead where the stock will actually respond to the improvements as well, not just the hope for improvements. So, would you say it's 50-50? Is it 70-30? How much of this has moved just on how people feel about the future?
Yeah, I mean, it's definitely moved a lot on the promise of new management. Bill Brown, formerly of L3 Harris, had a phenomenal run there, a lot of credibility. New CFO also has a very good track record. So you're really in good hands here. And so far in the last couple of quarters, the say-do has been very positive as well, which has been a bit of a step change versus what's happened for this company in the last few years. I mean, fundamentally, you're barely growing revenue right now, and they are actually embedding some SKU rationalization as well. So the fundamental pickup is still out in front of us. We're going to hear a lot more about that in February.
I mean, your point, too, is that while, maybe the revenue growth is not so exciting, the potential earnings growth is, because you label it at 50+% being possible, which you call best in class, versus the other mega caps who appear to be in a quietly negative revision cycle. Expand on that.
Yeah, no question. Again, this is a market where if you ain't first, you're last. And so we know all the growth guys in our sector. That's Vertiv, that's Eaton. Those are the ones that are exposed to the data center theme, which we are still very bullish on. But this whole other cohort, which we call kind of we have a certain name for them as well. We're looking down there for names that are very cheap, but have a tremendous amount of growth and earnings beats in the next couple of years. And it's not all those guys, and these guys definitely screen from that perspective. So again, a lot of this is driven by productivity, restructuring, price cost. So if they get any revenue growth, anything north of 3%, that's all gravy on top of what we're expecting.
Yeah. Rich, you got something? Because Rich Saperstein has the stock as well.
Yeah, look, I like the call. The question really is, with 10% operating cash flow margins, how are they going to deploy that to improve organic growth? Because in the end, we need to see the organic growth once the excitement on the stock runs out.
I don't think we really need to see organic growth probably until 2026, 2027. And a lot of that can be a function of the cyclicality of the business here. They're at relatively depressed levels when it comes to auto production, electronics exposure. All those things will carry these guys, I think, and at least drive an acceleration over that time period. And I think that's really all you need on that front. So, I'm really, it's not really a revenue story yet, and if we get it, then that's gravy. Sorry, was there another part to your question?
No, I think you answered it. Stock's up 4%. I mean, clearly the market likes the call, and we appreciate you being with us.
Yeah,
Steve, we'll talk to you soon.
Thanks a lot. Okay,
yeah,
bye-bye.
Steve Tusa, JPM.